Here is that promised interview. We told you we would be getting you HDFC Asset Management's Prashant Jain live on the market. And here he is. Here's that promised interview. Good morning. Welcome to ET Now. Welcome to our studios. Good to have you in the building again.
Good morning, and thank you for having me.
Okay, our viewers have been waiting to hear from you. What a March it turned out to be, an absolute roller coaster. The start of April is looking like it's going to be a dream run with the comeback of the markets. Before we go any further, tell us, what is Prashant Jain's assessments of the markets at this juncture?
I think the local economic conditions are actually quite promising. Over last few years, we have sorted out most of the regulatory challenges that various industries were facing. The I think the corporate NPA cycle is clearly behind us. The corporate leverage is, I think, a 10 or 15-year low. Broad-based recovery in profits across all segments of manufacturing, paper, sugar, steel, cement, textiles, metals, etc. So I think the outlook for private capex has also improved, though it may take a while to actually show up in the numbers. Infra capex continues to do well. So net, I think the outlook for local economic growth and continued strong momentum in profits is quite comforting. The concerns are basically two, I think. One, what is happening to energy, inflation and energy globally. And so that could, if oil spikes up sharply and stays there, it could put some pressure on India for sure. Though to be honest, I think we are better placed this time around because software exports, net service exports are now bigger than our energy imports, which was not the case 10 years back. So to that extent, I think we are structurally on a better footing. I think the other issue that will come back and continues to be in focus actually is the US yields. So while the gap between Indian and US yields is quite decent and that gives us cushion, but still if US interest rates continue to move up and they surprise the markets on the upside, I think it could lead to some volatility in the markets. Though to my mind, the impact of that on economic growth should be muted. Yes.
Morning, Mr. Jain. Nikunj also joining in. So good to have you back. Markets are at an all-time high. And if I look at last time when markets were at an all-time high, crude was at 75. There was no war in the world. Fed was not supposed to go this hawkish in terms of an policy stand. And there are challenges in terms of energy cost. So the factors have deteriorated. The macro has deteriorated. Yet markets have almost gone back to a new high. Almost at a new high.
I think, Nikunj, you are right, and let me give this some color. Because the current economic conditions around energy prices will impact different sectors differently. It is good for the energy stocks, clearly. It is good for the power stocks because power is coming back in focus. And this is what I have said for last couple of years, that the world has underinvested in this space, both in the physical world and in the stock markets. And of course, what is happening today in Ukraine was not clearly anticipated, but this brings back into focus the need for reliable sources of energy for fossil fuels. And it impacts, to my mind, banks also indirectly positively, because if interest rates go up, banks where less than, a very decent part of liabilities are in CASA, and where loans are more floating rate loans. As yields move up, it would be good for banks' margins. Inflation will also most probably lead to higher working capital needs. So credit growth in India, which has been lagging, that could also revive. So I think it is good for maybe half or slightly more than that of the markets. Where this will negatively impact is, I think, consumer demand could slow down because energy is a reasonably large part of the household budgets, especially the low income households. And that could lead to some loss of volumes or down trading. I think margins which have gone up sharply in the consumer stocks over last 5, 7 years, I think there we will see some pullback. And finally, if interest rates go up, it is not good for high multiple companies. So I think this does impact maybe a third of the market or so negatively. But I think the balanced markets are either positively impacted, and sectors like software, pharmaceuticals could also benefit indirectly if rupee depreciates. And sectors like utilities, honestly, should not get impacted much. So I think we need to break this down and simply not take a very top-down view.
The bond market is telling us that inflation is here to stay, and the equity market is still maybe believing it's a false belief or a right belief. I don't know. You're the expert here. But the equity markets are messaging that inflation will go away in FY20. It's time to look beyond FY23. What is the right approach? Which market will get it right? The bond guys or the equity guys?
So, Nikhil, I think 2 points are relevant here. One, I think anticipating higher yields, probably foreigners have already sold off quite a bit. And last few days, weeks, that selling is actually abated. So I think in anticipation, large selling has taken place. And I mean, we could get more selling, but at least for the time being, that seems to be helping. And second is, see, equities are neutral to inflation because inflation is a pass through for equities. So I think we have always discussed that long term equity returns are close to nominal GDP growth rates, which is real growth plus inflation. So if inflation goes higher, it means higher selling prices of consumer goods and services, and generally price levels go up even for other products. So I think inflation is to a very large extent a pass through for equities. They are a hedge against inflation. But I think it is the bond investors who will bond prices should see fall as interest rates go up. I think if you look at the past also, we've seen that rising interest rates uh, in moderate extents, I mean, they can continue with good markets because rising interest rates also at times signify strong economic conditions. But of course, if you take them to an extreme, when they start impacting the economic growth itself, and of course, cost of capital is gone up. So that is when equities start getting negatively impacted. I think in India, we are nowhere close to that zone because our economic conditions appear to be quite stable, quite robust, and a marginal increase in cost of capital in a fast growing economy where nominal GDP will probably grow maybe 12, 14, 16% a year. I think it does not impact much on the stock prices. And this is something I have said in the past also that in India, the growth is the key driver of stock returns, and some changes in cost of capital tend to lose significance over time.
You've liked utilities in the past, and even though it was a positioning which was pre-COVID, you stayed with them. That was great conviction, and now rewards are being visible. Now, what you enjoyed post the COVID period was a downturn in interest rates, which made utilities attractive. But do you think utilities will underperform when interest rates are moving higher?
Nikunj, I mean, that's a very logical question and that's a very logical way to think. But fact is that utilities in India have derated for maybe 10 years. And despite falling yields, the utilities kept on derating. And that was probably because many sections of the markets lost faith in fossil fuels. They lost faith in the entire focus was on RE, renewable energy. And ESG concerns also, I think, impacted stock prices of these businesses, not just in India, but world over. But I think now these stocks are coming back into favor, I think, for a variety of reasons. One, the world is probably realizing that ESG has impacted supply side more than it has impacted demand. The underinvestment in conventional energy over last 5-10 years is likely to lead to higher energy prices. And of course, what is happening in Ukraine, I think, will also encourage countries to onshore the key building blocks of the economy, whether it is and energy is clearly one of them. So I think to ensure security of supply, I think countries would prefer to have local sources of energy, whatever these be. And that's why, and these stocks are so cheap. I mean, the dividend yields were more than or are close to even bond yields. So I think even if cost of capital goes up marginally, I think there is still quite a bit of room for these stocks to be before they are fairly valued. And I also feel finally that, I mean, you must have observed what is happening on the power exchanges. The power prices are extremely high and there is not enough supply. India has not added conventional power plants for maybe close to 10 years, and demand continues to grow. So I think sooner than later, I think India will also consider adding more thermal capacity. And one final point, which again I think has been reiterated a number of times. See, in India, the demand for power peaks in the mornings and the evenings on a daily basis. And at these times of the day, solar power is not available. Storage is still very expensive. It is costing maybe 6 to 8 rupees per unit. So till the time storage becomes economically viable, I think we will need increasing amounts of thermal power. Yes.
When we met last, we were talking about how credit offtake is not picking up. I looked at HDFC Bank numbers, or a large book, it is growing at 10%. Similar indications are also coming from other corporate banks in terms of how demand is coming back. So, are we at that turn for banks where working capital and credit requirement will start picking up?
So you are right, and I mean, I think just to, for the sake of completeness, let me say that the NPA cycle, the credit cycle is clearly behind us. And I think credit costs will surprise us on the downside for some time. The credit growth indeed has been weak, and we are used to credit growth going ahead of nominal GDP. And for last 1 or 2 years, it has grown below nominal GDP. I think that should change at some point of time. And there are few things which could improve the credit growth in India. One, clearly, first and foremost, is inflation. Higher inflation across the board, delayed supply chains means people would want to run more inventories, more stock, and the cost of the prices of the working capital goes up. So I think that should be the first impact. Retail continues to grow. Home demand is doing exceedingly well. Home affordability in India is extremely good. So that piece continues to grow. I think the high profitability of corporate India, especially the capex intensive businesses across manufacturing, the sharp rebound in corporate profitability across the board, and deferment of capex in view of COVID, I think has led to a sharp deleveraging by corporates, and therefore the aggregate credit growth is quite low. I think that will change over time because we are seeing fairly large projects on the anvil across steel, across power, across oil and gas, cement, chemicals, textiles. I think I am expecting a fairly broad-based recovery. But as we understand, there is a gap between a decision to set up a new project when you actually start spending the money, and it takes even some more time before you exhaust the equity that is available with you. So I think there will be a credit growth in India should pick up. I think it may still take some time, though I do feel that the uptake should start anytime because of the high inflationary conditions that we are seeing.
Allow me to paint the scenario. Axis has acquired the business of Citi Wealth and Credit Card business. There is a big merger been announced of HDFC Bank and HDFC Limited. There is a big churn which is happening at banks in terms of the approach they want to have. What do you think? Where is the banking sector and the financial sector headed, given that every bank now is trying to follow a different strategy?
So, Nikunj, I think again, this is a very pertinent question, and I think the biggest change taking place in banking is the uh, quick move, the fast move to the digital world. And I think the emergence of fintechs has brought a deep sense of urgency in the banks to improve and to take their offerings as close to the fintechs for the consumer in terms of content and also in terms of look and feel. So I think uh, the banks that adopt digital successfully, I think stand to gain share. And this would be particularly true for the large banks. See, in the digital world, there are no constraints to customer service. I mean, geographical reach, the number of loans, physical processing, size of loans, none of these is a constraint. So, so I think the large banks with a good digital offering should be able to gain share faster in the future than what has happened in the past. And I think in the digital world, while technology spends will go up, but over slightly longer periods of time, I think the cost ratio should also improve. And as you become bigger, the balance sheets, the technology spends also should fall relative to the size. So I feel the environment favors larger banks and those who clearly are digitally ready. And I think the gap between those and the other banks should increase over time.
So, do you see a similar situation what is happening in steel and cement, where the small steel and cement companies they got weeded out by choice or by merger? A consolidation has already happened by government, a forced consolidation for PSU banks. So, do you think the smaller banks will be there, but they may not be creating a lot of wealth for shareholders?
I think, see, this depends. I mean, these are very long-term views. In the interim, if you get a good credit growth, if credit growth improves sharply and NPAs are behind us, the valuations of some of these banks are quite low. So they could still be good investments over the short to medium term. But I do feel that if you think longer term, two things will work against them. See, the technology spends on smaller balance sheets will be large relative to larger banks. So it becomes a comparative disadvantage. The ability to write big loans, Indian companies are now embarking on a large capex cycle. The project sizes are going up. So that would again not be supportive of small banks because as banks consolidate, as they become bigger, their ability to write bigger and bigger checks goes up. And finally, I think to start off also, the larger banks have far better franchise, far better customer profile even today. So there is no reason why they will not continue to build on that. So I think in short term, I mean, stock prices could move this way, that way. But what I was saying that over longer periods, over 5, 10 year periods, I think the gap between the bigger and the digital ready banks and others should continue to increase in terms of growth rates, in terms of profitability.
There's a data point which will just come up on a screen, which will capture the returns of some of the schemes which Mr. Jain has managed, and it's is so nice to see that on a 10-year basis, 5-year basis, 3-year basis, his schemes are now making to the top quartile in terms of performance. So I just want to point this out for our viewers that this is where conviction, experience, and long-term portfolio planning works. You may go through downturn patches of underperformance, but when the trends work out, everything just moves in a synchronized manner. Given where your positioning of the portfolio is, Mr. Jain, tilt towards value, tilt towards utilities, tilt towards corporate bank, are you happy to have this kind of in positioning for 3 to 5 years? You think the cycle which you've been alluding to from last 3 years will have another 3 years to play from a market standpoint, from a stock return standpoint?
I think Nikunj, directionally things have clearly improved, and few things that have changed. See, one is of course the rising commodity prices are directly supportive of this space. The second is it hurts the consumer-oriented companies which are relatively expensive in India. Two is of course the uh, profit growth has become fairly broad-based. And that was not the case until 2 years back. Banks were struggling, commodity was struggling, capex was struggling. So consumer companies could still deliver profit growth, and therefore there was a scarcity value of that profit growth. I think that is clearly disappearing because profit growth has become fairly broad based. So I think there should be a natural regression. I mean, excesses at both ends, high P's and low P's, they should experience some moderation. And finally, cost of capital is going up. So that impacts the uh, high P companies a lot more. And of course, it is common knowledge that this space has been out of favor for years. It is underinvested, underowned. So I think that also should help. As far as how long this will outperform, I think that is hard to say because we don't know when these stocks, how long these stocks take to reach fair values. It could happen in 6 months, it may take few years. So I would be more guided by valuations, and it is very tough to put a timelines to this. But I think we are meaningfully away from fair values yet.
Meaningfully away from fair value, that's what Mr. Jain feels when it comes to some of the utilities and the corporate banks. Now, just for the benefit of our viewers, I would like to bring this point out. It is not that HDFC mutual fund and the schemes which Prashant has managed, they've not bought into consumer stocks. 2008, 2009, 2010, they aggressively bought into Titan, Page Industries because valuations were different. Is it time to start looking at the classics, the classic compounders as many call it? Because if inflation comes down and if the base effect kicks in, consumer demand can also come back?
Yes, I mean, over time, as you know, these stock markets experience cycles, and I've experienced four cycles, and one cycle typically has lasted between 6 to 10 years. But I think that is still too early. I mean, what you are saying is a very logical way to think, and eventually that will play out. But I think that probably is quite some time away. See, I think we must also not forget that as time goes by, the penetration levels of consumer staple companies continues to improve. And as penetration level continues to improve, it should lead to lower volume growth at least in the future. So I think uh, higher increasing levels of penetration, uh, I mean, budgets under pressure, because please appreciate these are mass market products, and energy cost of a low income household will be between 10 to 2% of the monthly budget. So it will have meaningful impact on consumption in those income groups. And 70% of India earns below 40,000 rupees a month. So I think that is a significant issue. Profit growth is broad based, and cost of capital is going up. Let us not forget that these companies have traded between 2000 to 2007-8 around 12 to 20 PE multiples. And that was a time when penetration levels were lower than where they are today. So I would feel that there is still some way to go before what you suggested plays out.
You've managed, you've seen four cycles, and I can see that yeah, mustache now is graying. So is it age or is it pure pressure of managing public money through cycles which is adding to the gray shade in your mustache?
Probably a bit of both.
They say the best of Warren Buffett came after he turned 60. So can I say the best of Prashant Jain wisdom is yet to unfold?
I think we all continue to learn as we go by, and the more, I mean, longer you have stayed in this business, the more mistakes you have made and the wiser you are probably. So, I mean, I do hope that I make lesser mistakes in the future.
So for FY23, what should be the broad asset allocation call? When we started the year, Prashant Jain words were, we should not expect extraordinary returns. Then markets came down. Nobody expected Fed to become that hawkish. Nobody expected energy shock to go through. So for FY23, where do you think should be the right asset allocation, let's say for not the SIP investor. The SIP investor has to keep on investing. But let's say for an tactical investor, for an HNI investor, for an ultra HNI.
But Nikunj, I think, see, these are markets that are reasonable, and the market cap to GDP in India is reasonable, and growth outlook is decent, both for the economy and profit growth. So, and cost of capital should go up moderately in India. It may go up more outside India because clearly Indian cost of capital has not fallen as much as it has fallen in the West. So while there is a issue there, I don't think it's a very serious issue. And Indian markets have done well, held on well, even when interest rates were maybe 10-year yields were 8% or thereabouts. So I think the outlook for equities is reasonable to my mind, but valuations are also fair. So that means that if you hold equities for 3-5 years, you should get around nominal GDP kind of returns. And that is what I think I said earlier as well. Now, the challenge is that if you go outside India, the cost of capital could go up more. The the monetary stimulus in the Western world has been far more. So the unwinding should also have a greater impact. And whenever that happens, we have seen one very large round of FI selling almost 30 odd billion dollars. It is large, but more could come if US interest rate surprises on the upside. So I think one should be prepared for volatility. Equities are always volatile, but you could have more volatility here induced by outside India factors. If oil spikes up sharply from where we are, I think it is reasonable to expect some impact of that. So I would say the answer to your question would vary individual to individual, but the guiding principle is that whatever a person can hold for 3-5 years, whatever you can whatever you can tolerate volatility emotionally and financially, I think that is what we should keep in equities. And of course, we should expect near nominal GDP kind of returns, compounding returns.
Should be in double digit. If I add the GDP projection, inflation projections, we are still looking at early teens. So if your view is that nominal GDP plus minus 2% return is what we should expect, so that means next 2, 3, 4 years, early teen returns is a strong probability.
Yes, I mean, I see no reason why we should not expect that. If you look at the trailing 10-15 year returns in India too, it is in line with nominal GDP growth rates around 12 odd percent. So there is no reason why that relationship should break down over the long term.
Just two more follow-up questions. The headline which in a sense captured global markets last week was the inversion in bond yield. This may be easy for a sophisticated investor to understand, but from your hindsight, for an average viewer and investor to understand, when you see a headline which says that historically when bond yields have happened, it has led to recession in the world. That's a dangerous headline when you especially get it from the US market and from long-term investors when they are claiming there is historical evidence. How does one apply that in India?
See, I think what inversion means is that the long-term yields are below the medium-term yields. And therefore, if you expect economic growth to slow down sharply after some time, investors will take a view that after some, I mean, the long bonds could even trade lower. So those yields, the yield curve inverts. I think, see, one, I am not an economist, and two, I am not an expert on what happens outside India. But my view is that uh, inflation in the West would probably surprise us on the upside. See, last 20 years, US inflation has been low because consumer durables, the manufactured goods that were going from China were deflating, and the US manufactured goods, the consumer durable index, I think experience a deflation of 1.5, 1.6% CAGR for a fairly long period of time. And that is what kept inflation low in the US. That phase has clearly come to an end, and the manufactured goods are not becoming cheaper anymore. So I think the US inflation should move up. On top of that, you have the underinvestment in the energy space last 5, 7, 10 years. And energy is a large component of any economy. Energy impacts inflation in multiple ways. One, of course, the energy prices go up. Two, wages will have to go up. Three, logistics costs go up. Four, the cost of plastics goes up. So I think this inflation would probably surprise us on the upside, and therefore yields could surprise us on the upside as well. Let us not forget that 15, 16 years back, US 10-year was between 4 and 5%. If that happens, and these income transfers that have taken place in last 2 years to households in the US, as that is discontinued, as taxes go up because fiscal deficits clearly need to be brought down, I think it is logical to expect, though, I mean, I should not be taken seriously on this, but I think it is logical to expect that US growth will experience moderation over time. And that is probably what the yield curve inversion is hinting at. I don't think in India we should worry about this, because look at last 40 years. Our growth does not depend to a meaningful extent on US GDP growth. We are still driven by local consumption, by local business climate, investment climate, by local interest rates, by local reforms, local policies. So I think oil definitely impacts us a lot more. So I think that is what we should really worry about. And yield curve inversion, I think, should less of a worry in India.
Okay, I'm just going to throw in one last question, and that's not the optimistic in me, but this question has a tinge of patriotism and a lot of belief that we are in a good spot. FIs have been selling, but looking at the lay of the land, which is that Russia is uninvestable, the inflation in Turkey 60%, yes, 60%, sir. There are problems in China in terms of growth and where regulatory action is moving. Do you think by force now, foreigners who've been sold, they could be coming back? I mean, is there a strong probability for FI flows to reverse? It's difficult. I'm asking you a hard question. I know you'll start by saying that it's hard to predict flows, but let's put logic.
So, Nikunj, it is indeed very difficult because we don't know how US yields will behave. See, it is since India has outperformed sharply, the markets in China, Brazil, Turkey, Russia have done quite, they've underperformed. So India could have become a much larger part of portfolios. So someone may rebalance, someone may get outflows in EM funds, US interest rates may go up. Or the converse is what you are saying plays out. Okay, Indian markets, Indian economy outlook is extremely good. Foreigners have sold already quite a bit, so maybe they will bring in some money. I really don't know. I mean, medium term, I see no reason why India should not become a higher weight in EM indices, why it should not become a bigger portion of global portfolios. I think all that will happen. But what is also interesting is that we have seen 30, $35 billion of selling, and still our markets are holding on extremely well. I think what is a silent transition has taken place in India, and equities were a peripheral, a seasonal, a trading asset class 2 decades back. And today, I think they've become more core, more long term, more center of the plate kind of an asset class, whether it is through direct investments or whether it is through mutual funds or insurance companies. And I think that is what is gives us a reason to celebrate that our dependence on foreign capital flows has demonstrably reduced over time. And this, I think, if it remains like this, then Indian market should become less volatile compared to what we have experienced in the past. And that lower volatility could actually encourage even higher allocation towards equities from household savings. And that, I think, will be a win-win for everyone, for the country, for the households, for the wealth of this country. And I think that is what is really important to me.
Well, so nice to have you. You've really covered a range of topics, simplified complicated issues like bond yields in a very easy manner. By the way, sir, we are back in office, so hope to see you next time in our office. Enough of meeting online through Zoom. Time to push that off button on Zoom and meet in our office now.
Sure, Nikunj. Look forward. Thank you so much. Thank you.
Thank you very much.